SpaceX, we're talking about that big IPO coming up soon, and I just saw an interesting news article last week that the world's largest private credit firm just sold half of its SpaceX position 3 months before the biggest IPO in history. Wall Street is calling it profit-taking, and I think they've just told us exactly what's coming next, and it has nothing to do with rockets. By the end of this video, you'll understand why a 10x return in 4 years wasn't enough to make them hold, what that says about the next 12 months in tech, and whether you should be touching the SpaceX IPO at all when it prices in June. Let's get into it. If you're into long-term investing and want some great stock picks and mindsets and tips and strategies, subscribe to this channel. I post 5 videos a week for long-term investors. April 30th, 2026. Blue Owl Capital, ticker AWL, gets on a Q1 earnings call. Co-CEO Mark Lipschultz says, and I quote, "We made about 10 times our money. We've sold about half of it at $1.25 trillion valuation, and we're still holding on to half of it." Here's the timeline. 2021, Blue Owl puts $27 million of equity into SpaceX through one of their funds, Blue Owl Technology Finance Corp. They were already one of SpaceX's earliest lenders. They'd made loans to the company, gotten to know them, and when the equity opportunity came, they took it. End of 2025. That 27 million is marked as 195 million on the books. SpaceX is the biggest contributor to the unrealized gains in the entire fund. And here's the part that matters. It's the only aerospace equity in a fund that otherwise holds software loans. Q1 2026, they sell half at 1.25 trillion, lock in roughly 10 times their money on the realized portion and keep the other half. The stock pops 9 to 10% on the news. Earnings beat 2. Revenue 753 million against 687 million expected. That's the surface story. Now let's talk about what's actually happening. You see, most people stop and read the headline, Blue Owl sold, and they assume it's profit-taking and that's the end of the story. But on the same earnings call, Lipschultz said something else. He said sales like this are the ways we can offset some of those losses. What losses? Pause on that. This is a private credit firm. Their book isn't rockets. It's loans to software companies. Hundreds of them. And right now in 2026, there's a question hanging over every software lender on Wall Street that nobody wants to say out loud. What happens to a software as a service company when AI replaces the product it sells? Think about it. If you lent 50 million to a mid-tier customer service software company in 2022, and Claude or ChatGPT or some agentic system can now do 80% of what their product does for a fraction of the price, then that loan is in trouble. Not next year, now. CNBC reported this directly on the call. The executive said that SpaceX gains could offset potential losses elsewhere in Blue Owl's portfolio if software companies default. Their words, not mine. So when Blue Owl sells half their SpaceX position, they're not telling you that SpaceX is overvalued. They're telling you that they need a cash cushion because they think the credit losses are coming and they want realized gains booked before the wreckage hits the income statements. This is what sophisticated capital looks like when it's playing defense. They don't announce a recession. They quietly trim the winners and brace. Now let's talk about the timing, because this is the part that nobody's covering. SpaceX has confidentially filed with the SEC. Target valuation is $1.75 trillion. $75 billion has been raised, making it the biggest IPO in history. It blows past Saudi Aramco's $29 billion record from 2019. Blue Owl sold at $1.25 trillion, and the IPO target is $1.75 trillion. This means that they walked away from roughly 30% of upside, roughly $400 billion valuation on paper that they could have easily captured if they'd just held 8 more weeks. So why sell now instead of riding into the IPO pop? 2 reasons. 1, locking in private market liquidity. Pre-IPO secondaries clear at private valuations. The XAI Grok merger in February resets SpaceX mark to $1.25 trillion. That's a real buyer at a real price today. The IPO is maybe at $1.75 trillion. If markets crack between now and June, that $1.75 trillion number evaporates. Blue Owl took the bird in hand. 2, lockup periods. Even if you hold through the IPO, you can't actually sell. Standard lockups are around 180 days. So even if SpaceX pops to 2 trillion on day one, Blue Owl can't realize a dime until late December. That's 6 months of market risk for an incremental gain. Selling half now de-risks the position completely. This isn't a bet against SpaceX. This is a textbook risk management trade. They kept half because really they still believe in the company. They just don't believe in waiting. Bull case versus bear case. The bull case for SpaceX at 1.75 trillion. Starlink alone is doing somewhere between 12 to 15 billion in annualized revenue, and it's growing fast. Pentagon contracts are stacking. They're the only game in town for heavy lift launch. China can't compete on cadence. The XAI integration gives them Grok and a GPU cluster, which means they're now vertically integrated, AI plus infrastructure plus launch company. Nobody else has that stack. If Starlink IPOs separately later, that's another unlock. Index inclusion happens fast, possibly NASDAQ 100 within months. Forced buying from passive funds, and the bull case is clean. Bear case for SpaceX at 1.75 trillion valuation puts SpaceX between Meta and Google by market cap. For a company whose primary revenue lines are government contracts and a satellite internet service, index inclusion drives mechanical buying, not informed buying. The XAI merger added Grok and GPUs to the story, but it also added XAI's burn rate. Musk himself is the single biggest key man risk in public market history. Tesla's volatility is a preview of that. And the broader signal is when a private creditor's smartest operator sells half ahead of the IPO. That's information. It doesn't mean SpaceX dies. It means the easy money is already made, and anyone buying the IPO is buying at late innings. But I want to step back from the trade for a second, because there's a bigger pattern here that's older than SpaceX, older than Wall Street, and older than the United States. And once you see it, you can't unsee it. Here's where I want to zoom out to. 1815, the Battle of Waterloo. Nathan Rothschild, the most powerful banker in Europe, has built his fortune by being earlier than everyone else. A first mover. He has a network of couriers and carrier pigeons that gets him news from the battlefields 24 hours ahead of London. The story goes that he made a fortune that week by knowing Napoleon had lost before everyone else did. The line attributed to him is, "The time to buy is when there's blood in the streets, even if the blood is your own." It's famous because it captures the contrarian impulse, buy when everyone is panicking. But there's an inverse to the principle that gets less attention. The time to sell is when there's champagne in the streets, especially when it's your own. When the entire financial press is celebrating the largest IPO in history, when retail investors are setting alarms for the SpaceX IPO, when Musk is on track to become the world's first trillionaire, that is the moment when the operators who actually built their fortune over decades quietly trim the winners. Not because they think the party ends tomorrow, because they've lived through enough cycles to know that selling at the peak is impossible, but selling near to it into strength with realized gains booked in is how you stay in the game for the next 30 years, instead of blowing up in the next 12 months. This is the difference between discipline and gambling. Robert Greene in 48 Laws of Power says, "Don't go beyond the mark, which you aimed for in victory. Learn when to stop." Blue Owl already 10x their investment. That was the mark, and they stopped. They got their initial investment, and they still have more exposure to it. Most investors get greedy and hold on too long. So I have 3 takeaways from this. One is that the SpaceX IPO is going to rip and blast from day one. Retail demand will be massive. Index inclusion is mechanical. Lockups will keep the float tight for months. If you want to trade at that pop, fine, but understand that you're buying from people who paid 30 cents for $1 4 years ago and are using your demand as exit liquidity for the rest of their position. 2, the real story here isn't SpaceX. It's the AI software credit cycle. Blue Owl just told us on a public earnings call that they're pre-funding losses they expect in their software loan book. If you own bank stocks with heavy software exposure, regional banks with tech-heavy loan portfolios, or BDCs in general, then pay attention. This isn't a Blue Owl story, this is a sector story, and Blue Owl just gave us the leak to it. 3, the lesson isn't about SpaceX or credit, it's about discipline. You will get 10x in your career of investing if you stay in the game long enough. But most people give it back trying to get 20x. The ones who compound for decades are the ones who, when the number gets really stupid and overvalued, take half of it and let the house money ride. They cash in on their original investment, get back what they have, and still have some exposure. And that's what Blue Owl did. And that's what I encourage others to do, because it's what the historical record says works. And if you enjoyed this video and this breakdown, please subscribe. I post at least 5 videos every week for long-term investors.